Welcome back to the deep dive. Today, we're going to try and cut through some of this quiet noise in the market.
It's a slow grind.
Exactly, the slow grind. We want to find out where the real action is, and maybe more importantly, where the big institutional bets are hiding.
It's a perfect description for it, isn't it?
Yeah.
The market right now is, well, it's deceptive. You have this low volatility, partly because of the Thanksgiving holiday coming up in the U.S.
Right.
And you get this weird collision of technical chart patterns and high-level macro policy.
So our mission today is pretty simple. We need to pull the signals out from all that noise. I really want to know where we might see some immediate relief rallies forming, and what are the big long-term stories that institutional players are putting serious money on right now.
And that calm mood you mentioned, it actually helps. It lets these underlying technical structures show through a little more clearly.
How so?
Well, when liquidity gets thin before a holiday, volatility slows way down, and you often just see capital sort of quietly grinding upward.
Okay, so if we're looking for that immediate relief, let's look at the Bitcoin chart. There's a very specific technical target being talked about. What's driving this potential retest of the $93,000 to $94,000 zone?
That range is just crucial. It's a confluence of key resistance levels. It lines up almost perfectly with the peak we saw back in early September, and it's also the 61.8% fib retracement level from the entire last decline.
So hitting 93 or 94K, that doesn't mean we're in a new bull run.
No, not at all. But it would confirm that the current selling pressure is easing off. It would give us that much needed relief rally before we potentially settle back down again.
Okay, that makes sense. Let's unpack this then by diving into what you're calling the altcoin anomaly, because something really interesting is happening just beneath the surface of that BTC chart.
Yeah, what's so fascinating here is this dynamic of shifting dominance. Normally, you'd expect that when the whole market is in the red, capital runs for safety, right?
To Bitcoin. So BTC dominance should be soaring.
It should be, but we're seeing the opposite. BTC dominance is actually slipping.
Which means altcoins are holding up better. They're showing resilience compared to Bitcoin itself. And that feels really counterintuitive given all the recent turbulence. So why is that happening?
I think there are two major factors here, and they both connect back to risk management. First, the sources are all pointing to that massive liquidation cascade that happened back on October 10th.
Right. That wasn't just a normal dip.
No, it was forced selling.
Yeah.
It wiped out billions in leveraged long positions, and most of those were in altcoins.
So that event essentially just cleaned the slate. It flushed out so much of that bad leverage risk that the selling pressure on alts is now just much lower than it was.
Precisely. The slate is cleaner.
Yeah.
And second, we are seeing a real divergence in ETF flows. While Bitcoin continues to see some, non-heavy outflows, specific altcoin funds, we're talking Ethereum and Solana here, are actually showing sustained positive inflows. This confirms that institutional appetite is looking at specific assets beyond just Bitcoin.
That sets up some pretty compelling short-term plays then. Looking at the charts for Solana, for instance, it tapped the $120 area. Why is that level so important?
That 120 mark for Solana is cited because historically, it has produced these really strong immediate bounces. It's like a clear psychological and technical pivot point. If it holds there, the probability of a relief bounce is pretty high.
And you can't really ignore the high beta stuff either. I mean, even in the meme coin space, sources are highlighting that actual structures are forming. I saw one mention of a large cap meme coin printing a double bottom around 20 cents.
And a double bottom is just a classic reversal pattern. It suggests the asset hit a floor of strong buyer demand twice. That particular level is significant because it was the starting point for a huge rally before.
So when you see strong structure in the most volatile sector, that's a signal.
It's a signal that rotational capital is actively looking for these relief moves.
And if you need a real-time gauge for momentum, the sources flag Monad. Its post-launch performance has been strong. It's trading more than 50% above its ICO price.
Yeah, that was what, 2.5 cents?
2.5 cents, yeah. Does that kind of strength in a new project suggest, late cycle risk? Or is it genuine belief in new infrastructure?
I think it suggests that even though the overall trend might still be bearish, there's a lot of capital that's willing to rotate into these high conviction plays. The fact that Monad can hold it premium shows liquidity isn't just sitting on the sidelines.
It's just being very selective.
Very selective. The expectation, if this strength holds, is for a wider altcoin relief bounce before the market kind of settles back into its longer-term caution.
Speaking of caution, those relief rallies can only go so far before they run headfirst into the macro environment. So let's talk about the economic data we just got, because that's what really shifts institutional sentiment.
And this data, it leans overwhelmingly positive for risk assets. We saw these crucial figures come in: softer retail sales, a cooled core producer price index, or PPI.
And why is that so important? It's the Goldilocks scenario for the Fed, right?
It's precisely the Goldilocks scenario. Softer retail sales mean consumer demand is easing up.
Right.
Less demand means less pricing power for companies, which helps slow down that underlying inflation pressure, which is exactly what the core PPI tracks. It's a signal that the Fed's tightening is finally working without crashing the economy.
And even though the headline PPI was a little bit hot, it wasn't enough to derail that cooling trend, so it massively improved the outlook for rate cuts.
The market didn't even wait. The reaction was just instantaneous. The odds of a December rate cut immediately jumped to a massive 82%.
That's not a slight expectation. That is near certainty being priced in.
It really is.
And here's where it gets really interesting, where the tension builds. This sets up a critical moment because the next Fed meeting is only, 15 days away?
Yeah.
With 82% certainty priced in, we have two very different possibilities.
And this raises a huge question for you, the listener. Will markets start turning aggressively bullish right into the meeting, front-running that 82% expectation,
leading to a nice, quiet holiday rally?
Are we just setting ourselves up for the classic sell the news reaction, where the announcement is already priced in and traders just dump their holdings for profit the moment the cut is confirmed?
That tension is going to hang over everything for the next 2 weeks. And while we wait, we have to look at what institutional and corporate money is doing right now. This is where we see long-term conviction.
Let's shift to those institutional moves, because we saw some really surprising dynamics in the ETF space. First, the biggest surprise has to be the new Grayscale and Franklin XRP ETFs.
The launch numbers were huge. Over $60 million each on day one. That just dwarfs the initial launches for some of the big Bitcoin and Ethereum funds from earlier this year.
It's a powerful signal. That kind of initial velocity suggests there was a significant pent-up institutional demand just for XRP exposure that wasn't being met.
So the diversification away from just the top two is accelerating.
It really is. And meanwhile, the Solana ETF story is just relentless accumulation. 20 straight days of inflows for the spot Solana ETFs.
They added $58 million on Monday alone. Total inflows are now over $568 million. That is sustained strategic money.
It is. But while these funds are diversifying into alts with ETFs, the corporate balance sheet strategy is still singular: stack Bitcoin. We saw Metaplanet demonstrate this perfectly.
Right. They borrowed another $130 million against their existing Bitcoin reserve. Why do that? Why take on debt using BTC as collateral instead of just selling some of their stack?
And that's the key analytical nugget right there. When a company borrows against an asset instead of selling it, it signals extreme long-term conviction for, I'd say, 3 main reasons.
Okay.
1, they avoid a taxable event. 2, they clearly anticipate that Bitcoin's appreciation will crush the interest rate they're paying on that loan. And 3, it sends a message to the market. We think Bitcoin is going way higher, and we are willing to leverage our balance sheet to keep every single coin we own.
Their total credit line is now $230 million just to buy more Bitcoin.
That is a powerful indicator of belief. And then in parallel, you have Kraken making this aggressive expansion play, positioning Krak as a full global bank alternative.
This feels like a major structural shift.
It is. Kraken is launching a whole suite of non-crypto banking services: a MasterCard debit card, direct salary deposits, even integrated DeFi yield vaults. They're not just an exchange anymore.
No, they're aiming to be a fully integrated global alternative to traditional banking.
And giving users crypto exposure right alongside their day-to-day fiat services.
So we've got short-term money flowing into altcoin ETFs, long-term corporate conviction stacking BTC. That brings us to the big strategy question. How are the key influencers telling people to play this tension? We got 2 really different outlooks here.
We do. We have the classic Bitcoin maximalist view, the stackers like Avi Filman and Jonah Van Berg from the 1000X podcast. And then we have the more disruptive next narrative view.
Let's start with the maximalists. Their core belief seems to be that the recent sell-off was just a market overreaction to macro fears. They called it forced de-risking.
Right, not a structural top. And their strategy flows directly from that. Rotate back into Bitcoin.
The cleanest trade.
The cleanest trade, exactly. Amid all this uncertainty, they argue it's the best hedge because of its liquidity. Avi even said he added exposure around $80,000, and he's betting on a 50% plus rebound.
But wait, they are much more cautious on alts, even with the positive Solana flows we just talked about. What are their specific concerns?
They're disappointed with Ethereum. They say it's shown a lack of leadership this cycle, that hasn't lived up to its potential. And they warn that the broader altcoin market still shows really weak breadth and is vulnerable to any shock.
So their mandate is clear. Stack Bitcoin, be careful with everything else.
Exactly. Even if they're watching SOL and meme coins for a quick trade.
Okay, now let's pivot to that really forward-looking narrative from Coin Bureau's guy, focusing on something pretty advanced, X42. This is an open crypto payment protocol from Coinbase that could, fundamentally reshape how we and AI agents pay for things online.
This is a deep dive into the guts of internet infrastructure. The core idea is that X42 uses the HTTP 402 status code. Now, for decades, HTTP 402 has been reserved online for payment required, but it was never actually used.
It's just been sitting there.
Just sitting there.
Yeah.
And X42 is now activating it.
That's a huge commitment. How does it work in practice?
So it allows websites to charge tiny amounts, micro amounts per request using stablecoins like USDC. By using that 402 code, it can do web speed micropayments without needing logins or subscriptions or annoying pop-ups.
It creates a seamless payment layer for the internet that, fiat could never handle because of transaction fees.
Exactly. The internet gets its missing cash register.
Okay, but why is this relevant now? Why does this narrative matter in late 2024?
Because AI agents are fundamentally breaking the internet's old business model. The web today runs on ad revenue from human eyeballs, right? But as AI models and bots scrape more and more data, they consume all this bandwidth without generating any ad clicks. X42 solves this. It lets them make seamless, tiny payments for articles, API access, data, even for AI outputs themselves.
That's fascinating. It's a way for the internet to start charging the robots that are using it for free. And the sources mention Coinbase and Cloudflare launched the X42 Foundation, that level of backing.
It speaks volumes.
A major exchange and a major web infrastructure provider.
Yeah. It signals they believe this isn't just some niche crypto thing, but a necessary global standard. And it's designed to be chain agnostic. But for now, it's running on Ethereum's L2 base and Solana, which connects back to that altcoin strength we saw earlier.
We should throw in a quick reality check here, though. Transaction volume surged, 10,000% back in October?
When the news first hit, yeah.
But it has cooled off sharply since then, so the infrastructure is live, but we're not at mass adoption yet.
Exactly. But the framework is there, and the biggest players are betting on its necessity. So what does this all mean when we put the macro tension, the technicals, and these huge narrative shifts together?
We have to synthesize the short-term opportunities with the long-term conviction plays.
And we are positioned in this profound tension. On one side, you have the potential for altcoin relief bounces off these strong technical supports, and it's all fueled by super optimistic macro forecasts, that 82% chance of a rate cut.
That favors short-term risk-taking.
It does. But on the other side, you have the underlying longer-term downtrend in institutional caution. And that shows up as the stack BTC via debt mentality from guys like Metaplanet.
So it's a market caught between a short-term trade looking for a bounce and a long-term position hedging against everything.
Precisely. And that leads us right back to X42 for our final provocative thought.
Thanks, Fred.
Given that AI traffic is growing exponentially and the web's old ad model is breaking, consider the immediate real-world use case here. Will AI agents paying for web access with crypto, using status code 402, become the single biggest, most undeniable catalyst for mass adoption outside of institutional ETFs? It provides a real, functional answer to the why crypto question that institutions just paying fees simply doesn't.
That is a fascinating thought for you to mull over as you head into the holiday season. The robots might be the ones paying the internet bill with stablecoins. Thanks for joining us for the deep dive.
We'll be here next time to unpack the next stack of sources you need to know about.